strategist at SJS Markets in Hong Kong. Darius, happy Monday.
Morning.
Hey, let's pick up on Chrysler. The U.S. Treasury seems prepared to support Chrysler's asset sale, but its support is limited, isn't it? I mean, how much can the Treasury really do?
I think that in terms of Chrysler, they really are sort of in a corner after bondholders rejected the restructuring proposal. And right now it all depends on how quickly, how fast they could sell their assets and whether Fiat really is going to come in and put up a sufficient price for the whole thing to be worth it. So the Treasury has to really wait and sit because its hands are tied at this moment.
I mean, when you take a look at Chrysler and GM, they've been kept afloat with U.S. government aid. The U.S. auto industry, no matter what, will remain in the dumps, even if the two are kept off bankruptcy, isn't it? Is that the picture you're getting?
Unfortunately, that's correct. Basically, the business models of the big three are not working right now due to the huge legacy costs as well as the damage to their reputation that the loss in market share and the whole bankruptcy saga has brought. So they are all on life support, and no matter who buys them, unless the overall economy turns around, they will continue to bleed money. So whatever bidder is coming through must be betting on a relatively soon turnaround in the U.S. economy, which in my opinion will likely be a correct bet because U.S. GDP will probably begin expanding at the latest from Q3. So now actually may be a good time to start buying those assets.
Darius, apart from the auto sector, one major thing that we're tracking this week is, of course, the U.S. bank stress test. What do you think they will say? The stock capitalization, or rather recapitalization, is likely to be needed for at least a third of them. I mean, how much will they need?
So far, the government has been trying to sort of spoon feed us with the information about what the tests are going to reveal, and the latest is that most likely they will show a need for about $150 billion in tangible common equity capital for several of those banks. So the question will be, will the market buy this relatively low assessment of capital needs? And I think that they will not. However, they will be willing to give the banks and the government more time to prove that they can raise the funds and that their losses will not augment. So I think that after the results are announced, I would expect a correction in the market, but not a complete collapse, and we will not be seeing the March lows again.
All right, Darius, sit tight for the moment, please. Up next on The Trade, Temple investment strategist at SJS Markets is in the house. Let's rejoin him in Hong Kong. I mean, we heard Mobius saying, what, a bull market for emerging economies may happen by year end. Is that a view you share?
Oh, absolutely. We continue to tell our investors, or we said before the year started, that by the end of 2009, pretty much all major equity indices will be substantially gaining on 2008, and emerging markets are going to be at the forefront of this movement. You know, the BRIC indices, for instance, are almost 50% up from the lows that they hit last year. So we could say that the bull market has already started. And we do agree that there will be volatility to come, especially if our forecast that the U.S. market will see a substantial correction is true. But by the end of the year, the U.S. economy will already be growing, and the rest of the world will be about to embark on another macroeconomic expansion, so stocks are bound to be on the rise.
So how do we play emerging markets, Darius? Where should our money be in? What should we be investing in particular?
Investors should be focusing on those economies who are heavily exposed to international trade. They have suffered massive losses as pullback in trade finance and overall collapse of the global economy triggered fears that there could be, another Great Depression. And now that all macroeconomic data globally is showing signs of stabilization, those markets must benefit from a reversal of that pullback. So we are talking about countries such as Korea here, Taiwan, as well as Hong Kong and China.
We have the Chrysler bankruptcy as well as other risks. I mean, these are risks to a sustained rally, and that may affect emerging markets as well, wouldn't it?
Absolutely. Emerging markets will continue to sort of yo-yo in line with what's happening with major global indices, except that the amplitude of their increases and decreases will be higher. And in the short term, we do expect that global markets are ripe for a correction, but that, say, if S&P 500 falls by 10%, that would constitute a great entry point, especially in emerging markets, for a longer-term investor who is willing to wait, through the end of the year to see the results of the money he's putting to work right now.
Darius, we're getting results in the bank stress test in the U.S. as we were talking about earlier. How much could that weigh on markets in this part of the world?
Our part of the world is very susceptible to what will happen with U.S. markets after the stress test results, basically because of the huge interconnectedness of the global financial system right now and the still frayed nerves of investors. So if the U.S. financial system does fall substantially, then concerns that global recovery will be delayed are bound to weigh on Asia, be it equities or currencies. But again, I think this will be a temporary correction and a wonderful entry point for a medium to long-term investor.
Darius Kowalczyk, SGS Markets, will be right back with him very shortly. Still strategist at SGS Markets. He's in the house this morning. Darius, I mean, swine flu notwithstanding, I mean, where do you see the best investment opportunities? Risk appetite seems to be returning to the market, right?
Indeed, and for the remainder of the year, I believe that risk appetite trades are going to be major winners. So investors should be selling U.S. Treasuries, for example, with 10-year yield going to 4% by the end of the year, 30-year yield to over 5%. They should also, in the longer term, be selling the US dollar as well as the Japanese yen and buying the risky assets, corporate credit, equities, especially emerging market equities, and emerging market currencies. Those typical risk appetite trades will be major winners as the US and global economy recover. But in the shorter run, I believe that the markets have moved so fast and so far that a substantial correction is in order, and the short-term trade would be to actually reverse that and go into a temporary risk aversion mode.
You said as far as emerging currencies are concerned, I mean, buy them. So far, the won and the rupee have been the biggest gainers. I mean, will they continue to be attractive, or are you looking at other emerging market currencies?
Well, actually, the won and the rupee have moved so rapidly that I wouldn't expect them to continue outperforming, because in terms of the rupee, it would be really negative for the Indonesian economy, for their export side, if the currency continued to appreciate. In terms of the Korean won, it actually achieved our year-end target by now, and they still continue to have very substantial short-term foreign currency debt. So I wouldn't be looking there. But on the other hand, I think that there is still some further upside in currencies such as the Singaporean dollar, the Taiwanese dollar, and the Malaysian ringgit in our region. So those would probably outperform.
Darius Kowalczyk, Chief Investment Strategist at SGS Markets, thank you so much for your assessment on the trade today.
Thank you for having me.
Now, South Korea's biggest bank, KB Financial